Right now, the global economy is pricing in a soft landing. They're lying to you. Today, we're going to expose the data that shows a looming 10 million barrel oil shock, a $2.8 trillion deficit explosion, and the exact assets you might need to survive the 2026 fragmentation. All right, let's get right into it. So, if you listen to the big players, the major institutions like Goldman Sachs, you'll hear a story of cautious optimism. The official line is that we're looking at sturdy growth, a bull market that's just getting wider, and this perfect, non-recessionary environment where asset prices just keep climbing. It all sounds a little too good to be true, doesn't it? Well, that's because it is a dangerously incomplete picture. It's kind of like staring at the calm surface of the ocean and completely ignoring the tectonic plates grinding against each other thousands of feet below. The institutional baseline is missing these massive stress fractures that are just about to rupture the entire global system. So let's actually tear apart this whole soft landing myth. You'll see institutions like the IMF projecting this headline growth of 3.1%. But that number, it's incredibly fragile. It hides what economists call a K-shaped recovery. Just picture the letter K. One part, the top arm, is soaring, driven by AI and massive government spending. But the other part, the bottom leg of the K, is fracturing and falling apart under the pressure of geopolitical chaos and energy shocks. And that brings us to the very first and maybe the most immediate fracture. In early 2026, a geopolitical conflict didn't just rattle the markets. Oh no, it triggered the most severe and sudden energy disruption in modern history. I want you to forget everything you think you know about past oil crises, because this is a completely different animal. Let's just look at the hard data. No fluff. In March of 2026, global oil supply didn't just dip, it absolutely plummeted by a staggering 10.1 million barrels per day. Now, to put that into perspective for you, that is like the entire production of Russia, a top 3 producer in the world, just vanishing off the map overnight. And the price reaction? It was immediate, and it was brutal. North Sea Dated, which is the benchmark for actual physical barrels of oil, surged to $130. And this wasn't just Wall Street speculation. This was the physical market screaming for supply that literally did not exist anymore. So the real question is, how did this happen? Well, this slide right here lays out the catastrophic collapse of oil tanker traffic through the Strait of Hormuz. We went from over 20 million barrels a day, that's a fifth of the entire planet's supply, squeezing through this tiny waterway, down to just 3.8 million. It's a complete chokehold on the global energy artery. And look, this isn't just my analysis. This is the International Energy Agency officially calling the blockage of the Strait of Hormuz the single largest disruption in history. When the world's top energy watchdog uses language like that, you know the market is fundamentally broken. Now, if you want the raw intelligence the institutions are using to front-run this energy crisis, hit subscribe and click the bell right now. We don't do fluff here, we do data. All right, a quick but important heads up. This explainer is for educational intelligence purposes only. It is not financial advice. Please consult a registered fiduciary before making any investment decisions. Now let's move on to the second fracture, and this is where you can really see how these crises just compound on each other. While that energy shock was exploding, the AI supercycle was also kicking into high gear. But here's the paradox. This incredible engine for growth is colliding head-on with a severe power crunch, a crisis that's made infinitely worse by the disruption in fossil fuels. You see, we're in the middle of a nearly $3 trillion industrial buildout just for AI. And this isn't just about software and code. This is a physical revolution. We're talking steel, concrete, and silicon being deployed at a scale that just dwarfs any of the previous tech booms. And to put a number on it, just look at the capital expenditures from the hyperscalers, the giants like Microsoft, Amazon, Google, and Meta, that basically run the cloud. They're projected to spend a combined total well over $650 billion in 2026 alone. They're in an all-out arms race to build data centers, and the number one input for that race is just raw electrical power. And right here is where you see the fundamental disconnect. AI investment is moving at the speed of light. It's a multi-trillion-dollar supercycle. But the physical power grid, our actual reality, it moves at a crawl. In major markets, the wait time to connect one of these new massive data centers to the grid is now averaging close to 5 years. The demand is here now. The power simply is not. Okay, so you've got an energy shock squeezing supply and an AI-driven power crunch creating this huge infrastructure bottleneck. The third fracture is what happens when you decide to pour fiscal gasoline all over that fire. It is a fiscal time bomb, a massive injection of U.S. deficit spending colliding with an economy that's already inflationary and supply constrained. The catalyst for all this is a sweeping piece of legislation known as the One Big Beautiful Bill Act. And what it does is combine massive new spending with broad tax cuts, which effectively just pumps trillions of new dollars into an economy that is already short on energy, short on power, and short on raw materials. Now, to really grasp the scale here, just look at the context. Even before this new bill, the U.S. deficit as a percentage of GDP was already running near 7%. That's wider than almost all of its G7 peers and way above pre-pandemic levels. So the starting point was already completely unsustainable. So what does this new bill add to the fire? The Congressional Budget Office projects it's going to expand the budget deficit by an additional $2.8 trillion by 2034. This isn't just stimulus. It's a level of fiscal injection that seriously threatens to debase the currency. And what that means is every single dollar you hold loses its purchasing power. Okay, so we've laid out the three core interconnected fractures: a historic energy shock, an AI-driven power crunch, and a fiscal time bomb that's destroying the value of our currency. The big question is, how do you navigate this? Well, the data all points towards something we call a hard asset firewall, a strategy specifically designed to survive and maybe even thrive in this new era of fragmentation. The strategy breaks down into three very clear steps. First, you have to hedge the exploding geopolitical risk that's driving this energy shock. Second, you want to own the physical backbone of the AI revolution, not just the software stocks. And third, you must protect your purchasing power against the inevitable debasement of fiat currencies like the dollar. And this slide shows you exactly how to implement that strategy. To hedge the risk from events like the Strait of Hormuz crisis, the defense sector, which you can get exposure to through things like the VanEck Defense ETF, directly benefits from rising global instability. To own the AI backbone, physical copper is the one irreplaceable metal you need for both the data center buildout and the grid expansion. And finally, to protect against that fiscal time bomb, physical gold serves as the ultimate systemic hedge as confidence in government-issued money begins to erode. So, this leaves us with one final question. In a world of fragmenting supply chains and debased currencies, is the ultimate hedge owning the assets that both power and protect the new economy? The ultimate hedge isn't just buying tech, it's buying the energy grid that powers it and the defense sector that protects it. VanEck, defense, and physical copper are your firewall. Now, to see exactly how we're structuring our physical gold storage, click the video on screen now to binge our hard asset masterclass.